Hello everyone. Another video for you guys. It's Friday the 24th. I'm going to do this video in English. It's been a while, but let's let's get to the point. I want to show you guys obviously gold now. And welcome back if you are subscribed. If not, well, and if this is your first time, I motivate you go back into my channel and see the rest of my videos. The way I do them is I just talk out loud and speak my mind out loud. It's really that one conversation I'm having that I'm now sharing with you on how I interpret the market. So this is the daily time frame, and we have seen gold already showing that it grabbed the liquidity off 243, and obviously now we have a confirmation. Okay, so different would have been if this candle, if it stopped there and this one made a wick and then closed back up here, and then this one we see here formed up here, right? Whereas it would have held that sort of support right here, right? But if you've been keeping track, then you obviously know and seen this big drop in 2 days. That was Thursday and Wednesday, Thursday, and today the market consolidated. Now there is a broad, more general aspect of the whole thing, because on a weekly time frame there's a cup and handle, and I have a video up but it's in Spanish, so I'm just gonna say it real quick. I'm gonna show you real quick what that is. This is the weekly time frame again. I'm zooming out a lot obviously, but if you see it already, this is the U of the cup, and this all this consolidation is the handle and now the breakout. So we're seeing the beginning of a retracement to this area of 2020, 2050. I personally don't think it's going to get lower than 2060. I think minimum this wick right there. So, but I doubt it. I think it's the 2000 psychological price level is very strong. So what are we looking at now? Sorry. Obviously that big, rejection weekly candle, that is, it closed. As you can see, the market is perfect, and when I say that, I mean that there's algorithms running it. So that's why things get so on to point. So like, how do you explain that the market closed with this candle right where that wick of this day weekly candle is? That you can't, this wasn't a human decision of like thousands and hundreds of thousands of people saying, okay, I'm just gonna, let's call it a day. We're gonna stop. Everything is gonna stop here. I'm gonna shut my computer off. I'm gonna stop trading. Everybody's gonna stop trading right there. Come on. I'm not gonna. Let's not get into that. But point is, we're obviously gonna go down. Okay. If you ask me, this is obviously a decision candle, and this wick says it all, because it surpassed this one and it closed. Again, go back to my videos if it's the first time how I interpret things, but I'm gonna just go straight to the point. So this wick shows me it grabs liquidity up here, and it's sold it. It sold it very strongly. Now I do have more information on this, but this is more on the institutional level. I'm gonna switch real quick and show you this website. It's called Commodity Futures Trading Commission. I'm gonna do this real quickly. May bank participation report in futures. This tells me the banks that are currently in long or short futures positions. If I scroll down all the way to gold, I see there are 28 banks in total, of which 23 are non-US and 5 are from the US, that have 69,774 orders, or say future contracts in long, and 213,210 short. Okay. That being said, there is information to back everything up. Okay, so this obviously is not just price action. Like, yes, there is a short position of institutions, banks, and whatever, and obviously that's what triggered this, because from, I believe it was last week, right when gold was up here, a news came out. How convenient. News came out and it said that gold, copper, and silver are at its highest prices. And guess what? There are algorithms that work based on news. So the minute news comes out in regards to gold, algorithms get employed and they act upon price, meaning they buy or sell. Now there are two things that move gold. It's news and geopolitical events. These are the two main things that are moving the market. So I suggest you follow what's going on around the world. BBC, NBC, Al Jazeera, whatever. Because you need, if you're going to trade gold, you're going to want to know what's happening everywhere. Specifically where there's conflict, because that's the thing. I mean, gold is unfortunately, right? But whatever. So that being said, daily time frame, we're back here. We've seen a few, interesting arguments. Now, why did it stop there? Well, this is a pivot area, and it was an imbalance, and imbalance area between. Sorry, I have to click to let go of that. There it is. I'm gonna adjust that right there. Okay, now again, something that's algorithmically perfect. This is why I say algorithms are employed in running this. How do you explain that where this wick is and the closing of these candles stop right in the middle? I have that line to represent the middle. If I push this high to show that perfect imbalance, how do you explain these candles stop right in the middle? You see that? I'm going to show you again. From this wick to that wick of these candles, those are imbalance areas. And I didn't invent this. This terminology, these terms I learned from ICT. You might have heard of them or whatever, but I don't care who thinks what about him or what, but his ideas are there. Price does respect this over and over and over. These perfect prices and algorithmic concepts, however you want to look at them. But point is, they're there. So the market stopped there because this was an imbalance, and it's a perfect place to make a retracement before it breaks this stronger consolidation area of 2,300. So where am I going with this? Also, I don't know if you are familiar with candle patterns, but that's a perfect inverted hammer. And usually hammers indicate a change in direction, or at least what happens now, which is a retracement. So change in direction meaning up now for a retracement of this impulse down. Okay, so another thing I want to show you in the 4-hour time frame before the breakout of all of this. Okay, even actually the 4-hour, was it the 4-hour? Yes, 4-hour, that's it right there. And when actually 1 hour, you'll visualize it better. But this was Sunday. This is a Friday right there. If you can see at the bottom, Friday, Sunday, it breaks the resistance, maximum resistance, and then right away on Monday, boom, it closes. It makes a pretty big drop. That should have been quite the sign and footprint, institutional footprint, that was the beginning of a change in direction to a sell-off. Now let me show you something with the Fibonacci retracement. If we measure that right there, that wick from the top of the maximum, like the maximum to that wick at the right there at the bottom, look where the market touches perfectly and it collapses from there on, which is the 70.5, or as ICT concepts say, optimum time entry, OTE 70.5 retracement level. If you want to be more of a Elliott wave or whatever concept type of analysis, then this is again above the 61.8 retracements, and that's where market respects even the candles and the wicks and all that, and is now respecting all the levels. So check it out. Look where it stops. 200% right there. This is not, see, this is not. This is what I'm saying in the beginning. Like this isn't human behavior. Like a million traders aren't talking to each other on Reddit saying, okay, stop buying gold. I mean, stop selling. Now just, hold it, or get out, get rid of it and start buying now right at 200%. Like this, how do you explain this? This is pure algorithmic price delivery. And anyway, I just keep making points about it, and it's important for you guys to also take note if you haven't seen the market this way, because this is how everything moves. Okay, so now looking and by proving all this to yourselves and for me as well, like, to myself, and understanding this now, how do I go about what's going to happen next week? So there's another thing that is important for me to say, and that's part of a very important and big part of my decision making, specifically on my entries, because after many years of literally sitting hours and hours watching charts, I believe I have a very, very effective entry system, and that is based on the wicks and the bodies of the candles. Okay, now I'll explain it the following way. I have this area as an example of what I'm gonna tell you, but what you want to do usually is wait for each candle to retest the previous candle maximum, the previous candle closing price, or the previous candle minimum, or previous candle open price. Now, what does that mean? As you know, the candles, the open price on a bullish candle is where it starts, the body. The minimum is the tip of the wick. The closing price is where the candle finishes, and the maximum is wherever that wick at the top is. If we look at this candle, it closed above this one. It made that high. It made that maximum, but it closed there. So it made that high and it closed there. So the other one opens right there, obviously, and it starts coming down, but it fails to trade below the 50% of this candle. So what it does is covers the wick of it. So just on the wick, this is the daily time frame. Just in that wick, you could have traded something in the 5-minute time frame and gotten your money. Okay, and that works in the 1 minute, and the 5 minute, and every time frame. Now what happens with the next candle? Where does this one close? It closed way above this wick. It doesn't leave a wick, it just closed there. But where does this next candle try to retest and look for? The open price of the candle, but it stops right at the wick of the previous one, making a mirror right there. So you see that? This is the perfection of the market, and that's why when you start when you train your eyes to see this, and really quickly in the 5-minute time frame, your entries are going to be sniper entries, not to say the least, because that's essentially what you're going to be able to do. You're going to be able to enter almost purely right at the top of a wick of on a 4-hour candle, and that is a lot. Like, that's a very great job. So again, so continuing with this example, look at this bearish one. The bearish one starts, it stops right below the open price of the candle, and it retraces back up. The other one, what does it do? It breaks the minimum of this candle, and it goes to retest the minimum of the previous candle. It stops, it shows rejection. Where does the body close? Where does the open price and the what price does it look for whenever it fails to break that initial direction? Well, obviously the opposite. So in other words, I'll ask the question in a better format. When this candle shows rejection to the bottom, failing to break the supports, what is going to do is break the resistance in this particular case. Okay, and this concept, this explanation of things, you're going to see happen around here. So this is what I'm gonna eventually be waiting for in the daily time frame next week. Something very, very similar to this. So I'm paying attention to these wicks right there, this one. I'm paying attention to obviously this open and close price of these two candles, which is 2379. I'm paying attention to that wick right there, which is 2383. But I'm also paying attention to these ones over here. This wick. I'm paying attention to all this, to these wicks. Like, all of this area is now a very interesting area to start selling. Now, there's also another concept I'm not sure if you're familiar with, but more than the Fibonacci retracement is basically the 50% retracement range, which would be optimum entry or discount, premium discount. So I have here another type of, which is the premium discount, which measures a specific impulse, and it only shows me a 50% retracement. So if on this particular case I want price to be above the 50% for it to be a good sell signal, all this is a good area to sell, and ultimately you want to target initially the lower, the 0%. So back to that, because nothing assures me it's going to break, right? Nothing assures me it's going to stop and make a double bottom and then kind of consolidate here for, like, I don't know, say 3 weeks or 2 weeks more. You never know. But so that's why you target that as your first area, and obviously if it does break it, your next area would be this candle, then this wick, and so on. Now that's something else. That's like another topic, and where do you put your take profit? That's a very common question, but I'll get to that in a second. So you have the 50% range, right? Discount, premium range. So obviously, if you were buying, for example, let me show you what I mean. If I was buying, for example, we were looking. Let's go back to our example. So after seeing this candle close up here, and this one close up here, imagine you're here and you want to buy. What you want to do is wait for market to reach at least below 50% of this breakout. So if I'm going to put right there, I want to measure that impulse. And why do I stop here? Well, obviously it's because that's where the market started retracing. But notice what happens right below the 50% of this impulse that breaks this resistance. That's why I'm measuring just that. Obviously this is the daily time frame. If I go to a 4 hour, it'll be different. I have to zoom out and go to it. But so what I'm measuring is that impulse that breaks the resistance with strength. So breakout, pullback, continuation, and then retracement. And as a matter of fact, the first pullback, if I measure just the first pullback, even that respects the 50% under it, and then eventually also respects it. So this is very accurate. Okay, so that's why I am using this also, this idea that I need to wait, and you're better off waiting for price to be either a discount is at the bottom of the 50%, or premium, which is the top of 50% area. Again, what I'm going to do is measure from where this impulse starts right to where it ends, and that would be 2375.85. And look where it is, the 50%, where that wick is. Like, you see that? This is not, again, this is how it works. Welcome to the markets. This is mathematically and just visually perfect. This is perfect right there. Look where the 50% is of that candle. Of this push down, right where that wick is. So don't be surprised if Sunday opens, a candle closes right around here, because it goes to this wick and it goes to this open price. Right there, it leaves a wick, and then the next candle on Monday goes back up here, touches somewhere around here, and then retraces a little bit and closes up here. Then Tuesday comes all the way up here, and it tries to get all this out of all these stopped orders that are resting above this maximum of this candle. It retests anywhere above this wick, something very, very similar to like what this wick did here. It eats up, or something similar to what happened here with this wick. So the wick, right? So this wick, I want to see a wick anywhere around here. So Tuesday up here, and the candle closed right around here, or even below. And then Wednesday, you could see a last attempt, but failed to break maybe 2386, 2387, and then kaboom, collapse and close very low. Or it could be Sunday, Monday up here, and then starting Tuesday is going to start collapsing, right? But what I'm trying to say is beginning of the week is going to make a high, and then toward the middle of the week is going to make the down push, the decisive, strong, bearish continuation of that retracement. And if you ask me to be more precise, I'm going to show you where I am targeting that pullback to be based on the optimum time entry, OTE, or 70.5% retracement. So anywhere between the 79 and the 75%. And if you see, you might have already spotted that, but right where the 70.5 retracement level is, look where it's at right there, that wick. You see that? I'm gonna put this there so I can point it out. There it is, that wick. How, like, you know, I don't know how to explain that more in another way than just that being an algorithm, you know, leaving those sort of footprints. So this is my sell area between 2396 and 2405. I will be more than happy to be in a drawdown if I start selling at the 61.8, which is 2387. But I do personally think it might want to get 2395, 2397.50 maybe. And don't be surprised if it stops right in the middle of the 70 and the 79%, which is 2400. Look at that, 2400.95, but it's a round number. So yes, I think there is going to be a push now from Monday to at least Wednesday, because Monday is a bank holiday. But this is what I would expect to see. On the week, it's just a general 1 2 1 2 up, and then another 1 2 da. This is going to be quite strong to go eat all this down over here. So now it's going to trigger. Now the target is that low, all the way right there. So being the 61%, 61.8% of the extension of that retracement. Then it might make a pullback, you know, consolidate it for a little bit, a few days, and then kaboom with very, very hard push to that 150% extension where this area is, and eat that support right there to these wicks. So 2150. So I'll be putting the levels here. 2150, let's put it 2150.20 just for whatever, you know. And then I'll put this one right there. Pop. So I'm putting these lines to show, like, my eye, what is it going? What's the reference, the visual reference to put the line there? It's right where I put the line. This one, if I'm being technical, is right there. But I know I don't like to wait all the way there, because sometimes it fails to even reach there, and it makes a whole bigger retracement. I'm like, oh, I have to, like, you know, kind of struggle a little bit. I'd rather just close my trades right where the candles, where the bodies are. You see that? And the wicks is like whatever, like for 5-10 pips more, like I just, you know, just secure my profits right there. You see that? But it will get to those levels. That's what it does. Look at right there. You see, that's what the market does. Okay, so first target, First target of next week, obviously the support of where the market stopped on Friday today, 2329 basically. Second target would be 2285 to 2277. This, and then anywhere between 2156 and 2186, which that would be this consolidation area. So you basically target this. I'm gonna put this as an accumulation. Okay, excuse me, sorry about this. It's okay. Right, so essentially it's going to target that low of that consolidation and accumulation phase. And then on the longer term, once there, it's going to make a retracement again, so that could take a while. It could take maybe a few weeks for the market to come back all the way here to 2000 something. Specifically here, see this level 2070? That's why I say it might not get lower. If it does, it would be the 300%. So I'm gonna quickly edit this and add the three minus three. Yes, there. That would be 222 if you see it already on my screen up here. There, at 222, which is right below these candles what I was showing at the beginning. That and it makes sense if it does extend to it. I think the ultimate ground support bottom of gold would be 2022 right there, 2022. And so yeah, I think this is enough for you to have a general idea of what you can expect the few upcoming weeks on gold, because let me just leave it like this. And actually I'm gonna finish it saying this. Watch. The market is gonna rebound on the handle of that weekly cup and handle I showed you, and this is gonna go to the Bitcoin strategy. So I am going to buy next week, sell early in the week, ride that wave all the way to 2050 and start buying at 2040, 2022, and I'm gonna hold gold because I see it way above 3,000 in the next 2 years. Guys, I'm gonna leave this right there. I truly hope this video is of great use for you. Go back to it, review it. If you liked it, thumbs up, whatever. Do all that weird online thing, and if whatever. Happy trading. Good luck, everyone. Again, I'm not a financial advisor. I think I didn't say in the beginning, but see you next time.